Hi everybody, welcome back to Chapter 8. I'm sure that you're all familiar with the barcode scanning mechanisms used at grocery stores and other checkout counters. Scanners such as these are linked to a company's accounting records to allow for continuous tracking of inventory. Each time inventory is purchased or sold, employees scan barcodes attached to the merchandise. This provides management with real-time information about inventory levels and costs. In addition to barcode scanning, companies have developed techniques to further automate their management and recording of inventory. For example, some companies use inventory software linked to radio frequency identification tags, allowing inventory to be recorded automatically as it moves in and out of a company. Companies are also developing smart systems to use with big data to monitor customer trends and automatically initiate orders in real time as those trends change. These types of technological advances help to reduce the burden of physical inventory counts and manual record keeping. In addition, they make the use of a perpetual inventory system easier and more efficient. That's why nearly all major companies use a perpetual inventory system. Nevertheless, even with advances in technology to improve the automation of inventory accounting, many companies still must physically count the inventory on hand at the end of a period to verify the accuracy of the accounting records and to account for inventory damaged or stolen. Under a periodic inventory system, it is mandatory that a physical count of the inventory be taken before the financial statements are prepared at the end of an accounting period. A periodic inventory system will adjust the inventory account and record cost of goods sold only at the end of each reporting period after a physical count of inventory has been taken. It records merchandise purchases, purchase returns, purchase discounts, and freight in temporary expense accounts. And it will determine the period's cost of goods sold by combining the temporary purchase returns, purchase discounts, freight in, those temporary expense accounts, with the inventory account. And the way that is done is a manual calculation, beginning inventory plus net purchases minus ending inventory equals cost of goods sold. Let's look at the Lothridge example again and review the summary journal entries Lothridge would have to make if they used the periodic inventory system. First, the details. Lothridge Wholesale Beverage Company purchases soft drinks from producers and sells them to retailers. The company begins 2021 with inventory on hand of $120,000. The following information relates to inventory transactions during 2021. Additional soft drink inventory is purchased on account at a cost of $600,000. Sales for the year, all on account, totaled $820,000. Lothridge uses the periodic inventory system. After a physical count of inventory at the end of the year, the cost of the ending inventory is determined to be $180,000. The following summary journal entries would be used to record the inventory transactions for Lothridge Company. To record the purchases of inventory, debit purchases, credit accounts payable. And remember that this purchases account is a temporary expense account. It's going to go away when we do our adjusting journal entry to adjust the inventory. And to record the sales on account, we're going to debit accounts receivable, credit sales revenue, $820,000. And there are no entries to be recorded for the cost of inventory sold throughout the year. So, reviewing some of the facts again, Lothridge begins 2021 with merchandise inventory of $120,000. It's an important number. During 2021, additional soft drinks inventory was purchased at a cost of $600,000. Sales on the account for the year, sales on account all year long, were $820,000, and a physical count of inventory at the end of the year shows that the correct inventory at the end of the year should be $180,000. Notice how this number, and this number are all in colors, and this number is not. Big hint. To calculate cost of goods sold, we do not need to use the sales. That's extra information that are certainly necessary for the books and records, but not when we calculate cost of goods sold. So beginning inventory plus net purchases equals goods available for sale. Beginning inventory of $120,000 plus net purchases of $600,000 equals goods available for sale of $720,000. Minus ending inventory equals cost of goods sold, and the correct ending inventory is $180,000. So $720,000 of goods available for sale, less ending inventory per the physical count of $180,000 makes cost of goods sold equal to $540,000. The journal entry is going to fall out of that calculation. Let me show you. Here's that same calculation again. Look how the journal entry works. This is the adjusting entry to adjust the inventory balance at the end of the year, to close out the temporary purchases account, and to record cost of goods sold. Debit cost of goods sold for the calculated amount of $540,000. Debit ending inventory for the correct ending inventory amount of $180,000. Credit inventory $120,000 to remove the incorrect beginning balance out of the account, and credit purchases to zero out that account balance. That is so magical and so cool that it works so well. So, in summary, a comparison of the perpetual and periodic inventory systems is shown on this slide. And basically, the main difference between the perpetual and periodic system is that the periodic system allocates the cost of goods available for sale between the ending inventory and cost of goods sold only at the end of a period after a physical count of inventory has been done. In contrast, the perpetual inventory system updates the balance of inventory and cost of goods sold each time goods are sold. And that's automatically done. You don't have to take account of the inventory and make a manual adjusting entry to make it work. Also, the perpetual inventory system, as I mentioned just a moment ago, allows for the preparation of interim financial statements by providing fairly accurate information without the necessity of a physical count of inventory. But under the periodic system, you simply cannot calculate cost of goods sold, and therefore you cannot make your adjusting journal entry unless you count the inventory. That means the interim financial statements, and by interim I mean monthly financial statements or quarterly financial statements or semi-annual financial statements, or even the end of the year financial statements, simply cannot be done unless you count the inventory. Therefore, the periodic system is a little more expensive to use than the perpetual system when it comes to being able to prepare interim financial statements. However, to get the perpetual system up and going, you have to buy more expensive hardware and software. So overall, it is more expensive to implement than the periodic system. And the perpetual system will track both the inventory quantities and inventory costs automatically. Whereas the periodic inventory system, you can only get the ending inventory quantities by making a physical count of the inventory. So let's do a couple of problems for Golson Company. In this problem, I'd like you to calculate the cost of goods sold for Golson using the following facts. Please make your calculation, choose your answer, and then after you've finished your calculation, start the video again to check your answer. The Golson Company uses periodic inventory system. Information for 2021 is as follows. Sales were $1,325,000. Beginning inventory was $340,000. Purchases were $600,000. Purchase returns were $6,000. And ending inventory was $370,000. What is the cost, Golson's cost of goods sold for 2021? Did you calculate $564,000? That is the correct answer. Beginning inventory plus purchases, less that inventory we didn't keep that we returned, plus minus ending inventory calculates cost of goods sold. Remember, the formula was beginning inventory plus net purchases minus ending inventory equals cost of goods sold. Well, net purchases would be the $600,000 of actual purchase cost minus the purchase returns in this problem. The next example asks you to calculate the ending inventory for Golson using this set of facts. You should be able to calculate the ending inventory using that same formula. Golson Company uses the periodic inventory system. Sales were $1,325,000. Beginning inventory was $340,000. Purchases were $600,000. Purchase returns are $6,000. And cost of goods sold was $564,000. What is the ending inventory? Go ahead, do the calculation. And when you've finished, start the video again to check your answer. And the correct answer is $370,000. Using the very same formula, we just have a blank spot here. $340,000 plus $600,000 minus $6,000 minus something equals $564,000, and that something is $370,000. Well, this is a really good spot to end this video. I'll see you next time.